What is going on, traders? Was not going to make a video until after the holidays. However, there is some breaking news and some significant data that we have to go over before the market starts its new year in 2023. We are off to the worst December since 2002, but that is not the whole picture. There is a reason for this, and it might get a lot worse. So I'm going to break it all down for you in this video. Also, if you would like to see a 2023 video, how I would approach investing and trading in 2023, what are some of the most prevalent mistakes that I've seen in trading and investing from 2022 that I wouldn't carry over to 2023 and I would fix, leave a thumbs up and let me know in the description below. I will happily make that video for you, how I would approach investing in 2023. Otherwise, let's get into this breaking data and why the nightmare recession scenario could get a lot worse for you and for all Americans. Let's get right into it. So firstly, let's start with the most prominent piece of data to me, okay? This is the effective federal funds rate. Let me make this bigger for y'all. The effective federal funds rate in red and the 2-year treasury in blue. Now, why is this important? Please don't click away from this. I'm going to explain it to you even from a beginner standpoint. You've heard me say all year that the bond market was broken. There are so many ways right now that the treasury market is broken, from the illiquidity to treasury yield curves inversions, treasury yield curve inversions all across the board, the inversion between the 10-year and 2-year, the inversion between the 10-year and 3-month. Now we have this. This is essentially the inversion between the 2-year and the Fed funds rate. The Fed funds rate is the interest rate that the Fed hikes every single FOMC meeting since March. Let me just explain some things out of the way first. What is a yield curve inversion? Real quick, this is going to make a lot of sense to you, I promise you. So every single treasury, whether it's the 10-year, the 2-year, or the 3-month, they each have different yields. The yield is just the percentage that that treasury pays. So let's say the 10-year treasury is at 4%, the 2-year treasury, you would expect it to pay less than the 10 years, right? Because it's a much shorter duration. So let's just say that the 2-year typically, not right now, is at 2% and the 3-month, let's say, is at 1%. These are just hypothetical numbers. Now, if there is not any demand for any of these yields, right? The less demand that there is, the higher these yields go. The more demand that we have for these treasuries, the lower the yield goes, okay? So a yield curve inversion happens when the shorter term yields are paying more than the longer term yields. How does that happen? Well, that just means that there is a lot of demand for longer term treasuries and not a lot of demand for shorter term treasuries. And that happens when investors lose confidence in the shorter term market, right? Or in the shorter term economy. If investors think that inflation is going to go up, if they think that interest rates are going to wreak havoc, then they're going to want those treasuries, the shorter term treasuries, to pay them more yield. They're going to require more yield. So they don't invest in those shorter term treasuries and they opt for the longer ones. Because obviously in the long term, people are more bullish in the long term than they are in the short term. So they would rather lock in a 10-year yield at 4% versus a 2-year yield at less. But what happens is when there is less demand for these shorter term treasuries, these yields start to go up in a very, I don't want to say unrealistic, but in a hyperbolic way. So that is how you get yield curve inversions. Right now, what the yield curve between the 10-year and the 2-year is telling us is that the 2-year is paying more than the 10-year. And the 3-month is paying more than the 10-year. Think of how crazy that is. You can get a higher yield on a 3-month treasury right now. And anybody can do this. You can go to treasurydirect.gov. and you can get a higher yield on a 3-month than a 10-year. This is how low investor confidence is in the economy right now. All right, so that is a little bit about yield curve inversions. What is this here? The federal funds effective rate right now is hovering above 4.25%, right? Since the last time that they raised the rates just a couple of weeks ago by 50 basis points. Now, the 2-year treasury yield is typically above the Fed funds rate. Why? The Fed funds rate, essentially what it is, right? When the Fed increases interest rates, the Fed funds rate is just what is called the overnight lending rate. And that is the rate that banks lend to each other, lend their reserves to each other overnight. We've gone over it on this channel before, but let's just say that Bank A overnight has more reserves than Bank B, and Bank B needs some of those reserves to satisfy their deposit requirements. So they're going to want to get those funds from Bank A, who has a surplus in cash. Now, that overnight lending rate is really what affects all interest rates, because if the bank is paying that overnight lending rate, which is represented in the effective federal funds rate, then they're going to charge everybody, commercials and consumers alike, more interest. Since they are paying the Fed funds rate, they would expect to make money by charging more. That is how the Fed funds rate affects all interest rates all across the board. So the treasury market is so broken right now that the 2-year treasury is falling below the Fed funds rate. This means that why would a bank or an institution even go out and buy 2-year treasuries when they can essentially get more overnight? That is insane, right? We talked about the 10-year and 2-year, which seems crazy enough. The 10-year and 3-month seems even wilder. And now you have an overnight rate inverted. Okay, this is how dire the situation is. So what happens historically when this happens? Well, historically when that happens, the Fed usually pauses, but even more significant, we get a recession imminently. Now here's where the conundrum is, right? And the Fed paused every single time that the Fed funds rate was above the 2-year, except for one time in history. And that is the time that unsurprisingly mimics, or our time mimics that time, right? It's closely related to what was going on in the 80s with inflation. So every other time besides the early 80s, the Fed paused. Now, what is the inflation rate? This is the conundrum right now. The inflation rate as of the last CPI is 7.1%. So in this case, the Fed cannot afford to pause, right? Because even though now the 2-year treasury is below the Fed funds rate, again, how crazy is that? This means that the overnight rate is higher than the 2-year yield. The Fed cannot actually afford to pause here because inflation is still 7.1%. So this is very much playing out like the early 1980s, where the Fed had to keep rates higher for longer, which is what Jerome Powell told us in the last FOMC meeting. And if we take a look at this summary graph here, you can see that the Fed hiked further and faster than any other time in modern history, right? I would want to see this comparison, by the way, to the early 80s, because I only see 87 to 89 here. But I believe that the Fed hiked faster and more aggressively in the early 80s, but that's when Paul Volcker raised the rates to 20% to combat double-digit inflation. I think CPI was like 13.5%, so much worse than it is now. Either way, the point stands that this is historically insane. This is why you see others like Elon Musk and Jeremy Siegel just continue to deride the Fed for what they are doing with interest rates, right? I don't blame them, but it's like, what choice do they have? We printed all of this money. How do we now get rid of this inflation? Your choice right now seems to be what is called a true dilemma, right? A dilemma is a choice between two bad options. A dilemma, people use it incorrectly, is not a choice between a good option and a bad option. It's really a choice between two bad options. So in this case, we have recession on one hand and inflation on the other hand. And right now, it just seems like a choice between either, right? Either you pause prematurely, which the Fed said that they won't do, and inflation continues to be a problem, or you keep rates higher for longer and continue to break the system until we have higher unemployment and a recession, basically. Now, speaking of economic data and employment and all that, even more bad news, right? This is why I am in general more bearish about the market, and I will get into the market in a second, but in general, why I'm more bearish about the market going into 2023. For those of you who are fans of this channel, know that we've been tracking this level for months, even before we got there, when the market looked like it was going to bounce off of that 200-week moving average. And that is the area which we took a short. I will get back to the markets and my plays in a second, but I do want to go over some of this economic data that actually does not bode well for the market. We had a GDP revision today as of the time of this recording, December 22nd. It went from 2.6%. That was Q3 GDP, went from 2.6% revised the second time at 2.9%, and then today revised for the third time at 3.2%. A growing economy is not what the Fed wants to see, especially in light of this, right? The fact that the bond market is absolutely collapsing. The Fed is hoping and praying that what they're doing is going to work faster than it is, because it means that they can take their foot off the gas. Right now, even as things are crumbling in the treasury market, they cannot take their foot off the gas because the economy is still growing. And even worse, the jobs market is still going strong. As of today, we had the jobless claims. The Wall Street Journal was economists were expecting a 220,000 jobless claim number, and we only got 216,000. Now, I don't want to talk about in a crass way. I don't want to talk about people's jobs as if they're just numbers on paper. I know that these things materially affect people in a real way. So I want to be sensitive to that. But for the purposes of this video, we're talking about data. And, you know, the market was expecting 220,000 jobless claims, and we only got 216,000. So GDP is still growing strong. Prices are still extremely sticky, and the job market is stronger than ever. So, you know, all of these inversions that we have between the 10-year, 2-year, 10-year, 3-month, and now the worst inversion that the Fed does not want to see, because this is the inversion that they actually pay attention to, is the 2-year versus the funds rate. So it'll be very interesting to see what the Fed does in February. I'm not going to claim like I know what they're going to do. I don't even think Jerome Powell knows what he's going to do. I think what the Fed is hoping is that when the January CPI numbers come out, the January unemployment comes out, that there is some sort of, and when we get the new GDP numbers for Q4, that there is some sort of at least some significant sign that the Fed rate hikes are actually working, and that would allow them to potentially pause or, you know, talk about some sort of pivot. But it's really a race against time. Can the CPI drop in January and February before FOMC significantly enough where the Fed can actually justify pausing? Because this right here is a nightmare scenario for the Fed as well as for the US economy, because it means that the Fed will have to go harder for longer, right? I know that sounds funny. So in this case, as I said, I did short from this level here. I since closed those shorts, and then I opened new ones last week, both on the QQQ and the SPY. The QQQ ones are up 50%. The SPY ones are up 35%. Was hoping to add more. So we'll see if we get some sort of rally here that will allow me to take a more optimal short, because I do not want to short after a, you know, violent bounce from this trend line. I will definitely be posting these in the Academy. So for those of you that are in the Academy, you already know the plays. For those of you that are not in the Academy, if you want to transform your trading education in 2023, don't make it like 2022, where you plan to learn this stuff. You plan to learn how to trade options or plan to learn how to trade futures, and you've been putting it off. Fast track your learning today. Join the Academy. We will be raising prices in 2023. So this is the last time to get end of the year pricing. It's 25% off the Academy. The only other time we did this was Black Friday. So take advantage if you are so inclined. Would love to have you. Otherwise, I put out amazing free content here as well as Instagram and Twitter. So follow me on those platforms as well. Also, we just released these in black. These are the Nancy Pelosi Trader t-shirts. They did only come in white. We just released them in black. And these are also, I think, 20% off until Christmas time. So if you're looking for a great trading related Christmas gift, check out these shirts as well as all the other merch that's on there, the hats, the hoodies, whatever. Everything is 20% off for Christmas. But hopefully you got something out of this video. Let me know in the comment section below what you think of the recession prospects. Also, if you want a video on how I would approach trading and investing in 2023, leave that in the comment section below. Would be happy to do it if there's demand for it. Leave a thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.